Thank you so much for tuning in to Trading Day. We're going to start with the markets setting all-time high after all-time high. But when you look under the hood, the picture isn't as rosy. The CNN Fear Greed Index is showing fear. You have bonds rallying in tandem with equity markets. And under the surface, the technicals are poor. The concentration is becoming increasingly narrow. You don't have as many stocks hitting all-time highs as there were in previous cycles. Let's bring in Scott Chronert. He's U.S. equity strategist at Citi. Scott, thank you so much for joining us. What do you make of this? You know, the index is telling us everything is fine. We're at these record highs. But I guess to speak in Gen Z, the vibes seem off. Scott, what do you make of that?
Shauna, thanks for having me. So I think you characterized it pretty well. You've got two forces at work here that are sort of counteracting, right? So under the surface, as we get further down this hawkish Fed narrative and potentially set up for a pivot to something less restrictive, what comes with that is some unraveling of underlying economic activity, which would predicate a Fed action, if you will. And we think that's starting to show up in areas of the consumer, some parts of industrials where there's some signs of fraying around the edges. So this is an overhang on certain parts of the market. You actually see this quite clearly as you go down cap into the small cap arena. On the other side, we have the AI-driven cohort of the market, the Mag 7, if you will, that continues to drive the narrative and does set up for this ongoing perspective that, hey, we've got a growth driver in town that's unfolding very clearly and maybe broadening in Gen AI, and it's starting to offset some of the underlying macros. All told, what ends up happening is that your Mag 7 component, or certainly parts of it, are really driving the bus right now, but they don't tell the whole story of what's happening more broadly across equities.
Well, let's pick apart these two different parts of the market, to your point. I want to start with that AI-driven basket. In your assessment, are they earning their keep, or is it entering kind of bubble mania territory?
Yeah, we're pretty confident we're not in bubble, and we do think at now the earnings expectations have been rising along with the price action. So you've actually seen your PEG ratios, your PE to growth ratio, come down over the past year, which essentially is telling us that, hey, these stocks are on pretty solid footing as far as earnings expectations go. That's really what's driving the action. We just have to be attentive to what degree those earnings expectations can continue to show a beat and raise biases going forward. We think the outlook in the second half is pretty clear. Different stories, you look more broadly across the more traditional economic sensitive part of the market.
Let's talk about the so what of all of this. I think there's a thought out there that one of these two sides will win out. You know, either AI will bring everybody along for the ride, or, you know, this is the last gasping of air by a narrow concentration, and we're due for a pullback. How do you think about that?
Well, I think the setup right now, we have to expect pullback risk is probably increasing. One is a function of moving higher. What that does is it increases the underlying implied growth expectations these companies need to deliver to keep the action moving in a more positive direction. So that becomes a risk, and that really puts burden on beats and raises as we go into the Q2 and Q3 reporting periods. But I do think that we have to be attentive to that. This is a lot about timeframes. And so while we can measure a lot of these more pure plays on generative AI according to what's happening right now in terms of incremental revenues and earnings, longer term, we do think that under the surface, this is going to be a productivity enhancer for many aspects of the broader U.S. equity markets, particularly large cap. And ultimately, that can be a real positive read through for margins, for profitability, and therefore for valuations. So it's all a function of how you think of timeframes right now.
Okay, with that in mind, are you sticking with momentum, or do you see opportunities in some of the names, that are being cast aside? Transports, for example, some wobbling in consumer areas. How do you think about those opportunities?
Well, we're playing an interesting balancing act going into Q2, and we're nearing the end of Q2 now. We made a couple of key decisions. We pulled tech from a long-standing overweight down to a market weight, meaning essentially we want to hold these stocks. We don't want to be out of them, but we want to be measured in terms of how aggressive we are chasing them. But what we did do is begin to move overweight those parts of the market that should ultimately benefit from a change in the Fed trajectory. So we went overweight consumer discretionary. We lifted autos. We actually maintained a bullish view on the industrials, bullish view on banks. So essentially, the way we're playing this is two-pronged. We want to hold those momentum leaders. As you say, I think they're still earning their keep in terms of the earnings growth profile. But with new money incrementally, we want to be pushing down a path that begins to set us up for a gradual pivot in terms of the Fed rate trajectory.
Is the bond rally doing anything for you in terms of looking at more interest rate sensitive names?
Well, the recent pullback in 10-year yields is certainly helping this growth narrative. And the other thing we need to consider on this is that as you go into periods where the economic activity can look a little bit more mixed, there is this dynamic where investors will seek out growth as defensive, right? And so in that case, these mega cap growth companies can come to the fore. But to your point in the bond market, yeah, I mean, certainly when you're looking at higher valuations, any relief in terms of 10-year yields in particular is an added attribute.
I mean, I'm looking at a sector like utilities, which has run up in part because of the move we've seen lower in bonds. And I don't know, there seems to be an AI narrative attached to that as well. You know, what makes sense? What doesn't make sense to you when you take a sector like that into consideration?
Well, okay, so if you look at where we're going in terms of debt levels, the mega cap growth cohort tends to run with very high cash. They've probably been benefiting from higher Fed funds rates because of the interest income earned. At the other end of the spectrum, you have sectors like utilities, like the real estate market, where there's bigger debt maturity cliffs ahead, and where there's a higher level of generally debt in general. And so as you begin to get closer and closer to that Fed pivot point, you take some pressure off of that. But to your point, I mean, I think with the utilities, there is a thesis unfolding that the grid is going to be tested in terms of the incremental demand we need to kind of sustain the data centers that are behind the generative AI. So there's a rate influence potentially, and then there's also an emerging fundamental influence. And all told, you look up and utilities are one of your top performing sectors thus far during Q2.
Before I let you go, we've been talking, about fundamentals. What kind of questions, if any, are you getting these days about election risk? We know historically election years are good for the market. Is that trend, do you think, going to hold up this year?
Well, the question's coming up a lot. And, the way we've been kind of casting it so far is that, one, we have to be prepared that platforms will probably still unfold between now and the election. Two, we're of the view that you can't just use the previous two elections as a playbook for this. We think it'll be different this time. And then three, we're actually viewing both candidates at this point as at the margin probably equity negative. And what it really has us doing is causing us to shift our sights on that unfolding U.S. deficit situation as we go into the post-election timeframe. And that brings into question, again, where we are with interest rates and the influence that has on interest expense for the government. So all told, election is going to be an area of volatility going into the second half. We have to expect that. It combines with the sort of the euphoric readings that we're seeing in sentiment, the extended implied growth expectations to give us one more reason to begin to expect some volatility as we go into the second half of the year. Net, though, we want to be positioned to use such volatility constructively, even though we're going to have some issues to contend with on the other side of this.